Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for July 6, 2019. Market remains in bullish normal conditions. It's well overbought on both an annual and a 10-day basis as measured by the NDX 260 and the NDX 10. In the market mosaic, price with respect to the 200-day moving average is green bullish at 7.52% above the 200-day MA. The slope of the 50 is improved to yellow bearish at 0.21. ADX is a neutral but approaching strong 24.4 for the bulls. Risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. The current reading is at 1.082. That leaves us well into risk on when we find the risk Z by looking at the last 5,000 trading days, finding the standard deviation and the average. We compute risk Z at a score right now of 0.81, meaning it's 0.81 standard deviations above the long-term average. You can see this wall of worry it has climbed as volatility has decreased over the last 3 weeks, and we still have room to go to the upside, so the potential for a continued swing strength is still there. This has been very good for swing trading on the long side, this decline of volatility. In blended month rebalancing, you can see the holdings we have for the month of August and the leaders in the clubhouse based on closing prices on Friday. In ETF2, the theoretical exposure is at 100%. I want to highlight while we're here this link that I've just put into SurveyMonkey. That is a place for you to upload your weekly FAQs, and there's a space in there for you to also put your POC information if you'd like to collaborate with other members of the community of practice. I will collect your POC information there and share that strictly with people who have agreed to collaborate or looking to collaborate, and then we'll make those connections and allow you to work together. Maybe the easiest way of all is to, as a subscriber, is to just go to the chat room and post your information there too. You can do that as well. You'll find people that are actively interested in working together in the chat room, so that may be the fast track to collaboration. Moving on to look at some of the BMR portfolios here. This is ETF 13. Everything's in a buy signal. Technology and real estate have had the biggest rebound this week. Technology clearly out in front. Latin America had a rebound as well, but if you're looking to reward strength, it's in technology and real estate. ETF 32, expand that a little bit. Again, it becomes technology, Brazil, consumer staples all had really good weeks, along with, again, real estate and Latin America. Most everything is on a buy signal. The only laggards right now, commodities, energy, and China. In the Dow, best performance, Travelers, Procter & Gamble, Apple, Cisco, and Nike. And key leaders basically continued to lead. So if you look at the blended percentage and you look at the performance over 1 week, you see they all had really good weeks. So leaders continue to lead. Generally speaking, the laggards continue to lag, so you get extreme performance at either end of the curve. Momentum is kind of working right now. And the sector spiders, big weeks from insurance, technology, again, real estate, and telecom. Leaders basically continued to lead. Laggards really suffered in the energy sector and the basic materials. In the ETF Max, you can see the leaders all had pretty good weeks, with the exception maybe of gold miners, but clean energy, insurance, some metals had a good week. Palladium has been in the press quite a bit lately as well. ETF2 regional report all of the top 10 indexes are on buy signals, so that keeps us at 100% invested, 0% cash in the theoretical allocation model. The S&P with a strength of 72 is better than the globals at 58, so it's still all U.S. all the time. Inside the U.S., it is technology at 75, then the large caps, then the mid caps, then the small caps. The S&P and technology are two leading sectors. Emerging markets in Latin America, the lagging sectors. Leading the way inside the U.S. in the sector spiders, technology and staples leading, energy's lagging. So you can see the consistency there. Nothing really of note here in the world market model. ETF 30, using the ETF 2 lens. Gold miners have had a nice rebound here. They are green and white, along with dividend appreciation and the consumer staples. Otherwise, the leaders continue to lead. Brazil at white and yellow is beginning to start making its move to recover off the bottom. And then in the liquidity, you can see these in green are ones that are both very liquid and very volatile, make excellent day trading candidates. So miners, Brazil, semis, oil and gas, and U.S. oil. Shifting to the daily. In the market health check, the big yellow box, the 30-day trading range, you can see we're right near the top of that. The 10-day trading range in orange, we're near the top of that, and then had a positive day Friday, basically Thursday and Friday on low volume in the holiday weekend. There was no fear holding over the weekend. Economic information was mixed with respect to probabilities of getting a rate cut, but general optimism flush in the market. We'll see if that's able to maintain and keep pushing to new highs. In the event of failure of that, a break below like 296 here would then open up this trigger of ladder of prices to the downside. But for right now, it's all systems go to the upside. In the Four Seasons of MACD histogram, we entered the fall right about here, but this recovery of this week keeps it at a flat fall, and it may become like an Indian summer if we get some more gains here. We're right on the cusp of doing that. So I'm ready to reward momentum to the upside, but I'm also ready to capture profits. And then around 296 is where I'll be looking to get some tactical short side opportunities, but don't want to argue with the bull, so those will tend to be very short-term in nature. No signals and channeling and overreaction. You see the 10-day max pains, Boeing, Caterpillar, Johnson & Johnson, Intel, and Cisco. So Intel and Cisco become real interesting candidates for potential recovery moves because tech has been strong, but they were 10-day max pains, so there's some catch-up that they've got to do there. Whereas if you look at technology being strong, IBM is a min pain candidate, and that means that it's been doing very well. It has lost the least from its 10-day high, so that's where you might look to reward momentum, and then these would be value on sale under the max pain. Very few signals in the Dow 30 tactical, but quite a few good frog quality numbers. Strength on the going into the weekend was United Health, Nike, Morgan, and Goldman Sachs. No breakouts on the NDXs. In the ETFs, basically the same thing. Just a couple auto framers and a few 551Ws in oil, exploration, oil, and gold. Now those are interesting because energy has been weak, but they had a strong one-day move going into the weekend. So I think I'd be interested in looking at them as a continuation play. Plus energy and oil exploration, both are the only ones that test out well on the auto framer. So there's room to the upside for normal hydraulic lifting, if we could say it that way, in ETF 30. Pinch and stretch, you see quite a few are well above their Bollinger Band mean. These are the relative strength leaders. The most negative Z stretches, even those are above their Bollinger Band mean. So this has been a broad-based upward move. The most expanded pinch box. So gold with a 4 sigma stretch, that tells you how directional and powerful that recent move has been. You'll notice when we do the next video on sector chart reviews, that has been such an extraordinary gain that it's hard to see how it sustains in the absence of sudden shocks in the U.S. equity. So I'd be looking at preserving profits in gold rather than starting new positions. Mexico and United Health, both in the super pinch category, so I like those for swing potentials. Auto framer standard framing here for mechanical entries and exits, and then the regression line fractal framework. The top shelf are the ones that are the most numbers of ATR below their RL270. So these are the ones that are deeply discounted and have a way to go back to their fair value. So like natural gas is almost 5 ATRs, below its fair value, and 3M is a little over 4. We'll see that when we look at the charts in the next video. The top shelf in red, these are the ones that may be overheated. These are the relative strength leaders that are the most numbers of ATR above their long-term fair value, the RL270. So these are ones that we want to make sure that we're locking in gains, but also looking to reward continued momentum because it's a proven leader. Daily squeezes, these are one-day narrow range compressions that if it just gets a mechanical entry and gets an average range, you'll get some really highly favorable reward to risk ratios on one-day pops. So that's part of our swing trading one day at a time. 4 seasons of MACD, you see most everything in the fall, and then you can find where they are with respect to their longer term averages based on price with respect to its Red River. The ones I like to look for in general are symbolized by this pattern in GS, where it has had a strong measured move. In this case, it was down to fair value at the 270. Then got an RLXT entry when it crossed the dragon, and then made the move back to the 200-day moving average, where we ended up adding a second position. And this became a much stronger move as that momentum continued all the way up to the hump of the dragon. When it made this gap up, we moved our stop up into here, so that's sort of an opportunistic profit preservation while staying true to the potential of a swing that it might have continued and break out to a new high. So by being prepared, we were very lucky. So what that means here is I would be looking at those that are early in the summer, like Morgan and Goldman, that are below their Red River and have a way to continue to go. And then the ones that are at the very peak of the fall, Johnson & Johnson and Pfizer, these are ones that have moved so far but have rolled over but are well above their long-term average. So that has a long way to fall in the fall. So I'd be looking to preserve profits here. ADX stat, still playing with this indicator. This shows the relative strength of trend compared to its long-term look-back period, the last 500 days. And so like gold, the way to read this is its ADX rating is 45. That's 2 1/3 sigma stronger than its previous trend. That tells you just how strong the trend in gold and treasuries have been. So if you're holding those positions, just recognize it would be very hard for it to maintain that same rate of advance. It would be normal to see the trend begin to diminish now that all the buyers have bought. So that gives me reasons to be concerned about preserving profits there. On the other end, in the red, these are the ones that are exceptionally untrending. And so things like Brazil, Latin America, and Europe, these are all have been extremely choppy and sideways, and so lack of trending. So that may be a case where we frame that in both directions to see which way the next trend begins to unfold. Market mosaic for the S&P, looking at the market, the strong 30-period regression line, that is, when you drop down, you can see that slope is now more than 1 sigma stronger than normal. So this is like an officially very strong 30-day move. And you can see that the last time that it approached this level, it rolled over, and then it went from this kind of strong trend to this kind of choppy weakness, leading to further sharp sell-offs. So now we've recovered from that sell-off and are now testing previous highs, and it's still up into nosebleed area. So a strong move in either direction actually would not be surprising once it gets to this level. There's room to go to the upside, but Profit taking and weakness would not be a surprise to anybody. And so this kind of 295 level is sort of the firewall to preserve this move. And then 290 would really be the signal for lookout below. And then it would be all the way to 285-ish and then 275. So those are the moves on the downside. The Z-scores of our 10, 30, and 90 regression lines. So the 90 has cooled off. So this really strong move here caused the 90-period regression line slope to get all the way up to 3 sigma. This choppiness and sell-off brought that 90 back into the range of normal, but it's finding some strength here. So now there's room for the second leg up. So if this was the first leg, second leg, third leg in this last move from 235 to 295, which is a 30% move, by the way. Now we would look at this as the first leg of the potential next move up. So now we could see another $10 to the upside if the market can digest this economic data and get a Fed rate cut. I would not be surprised to see some gains here. On the other hand, the 30 has had an exceptional move. So to me, the most likely course of action is a tactical retreat back here to about 285 and finding support. That would be the least surprising move of all. So I'm being prepared for tactical short-term plays here as we continue to get deeper into the silly season of politics and with the market being concerned about the psychological impact of further Fed cuts based on economic data. And that's everything I want to cover for this week. I'm just going to flip through the other deeper research slides for those of you keeping score at home, so you have something to look at. There we go. This is Canna Tortoise Capital. Keep your risk measured and your powder dry.